Welcome back to the Beat the Odds of Business Wealth podcast, Trevor. We have an interesting episode here today. We're going to talk about 50-year mortgages.
50-year mortgages.
We're
wow.
going to talk about.
When I saw this announcement come from the Trump administration, I was just like, "What in the Black Rock is going on here? This sounds crazy."
Yeah, and a lot of people won't know is like we already have 50-year mortgages here in Canada. They're not going to be the same as the one that Trump's rolling out, but we already have them, and we're going to go through, what people are probably not thinking about in 50-year mortgages, because I think they're asking the wrong questions. And, what the differences are between the ones that are already available in Canada and the ones that are likely going to be rolled out in the U.S. and why most people are looking at them the wrong way.
Yeah, for sure. That sounds great. So what do you got for us today? When I'm a little bit embarrassed because, I am a licensed broker, but I mainly deal with residential real estate, not multifamily. So when you said there's 50-year mortgages, I'm like, what?
Yeah.
50-year mortgages. But that's not for everybody, right? So maybe explain a little bit about who it's for and get into the details.
We have them, and I'm going to do that one second. I'm going to do the residential ones that Trump is planning to roll out in the U.S. first, just for context, because it's going to be a little bit easier to understand. Once you understand the concept of the simpler ones, you'll get the more complicated ones already available in Canada, and you'll understand the perspective of why they already exist and why people are asking the wrong questions about them. Okay.
All right.
So because first of all, I hear the wrong question that people are asking is like, what is the interest I'm going to pay over the life of the mortgage? I don't care. That's not what I care about. That's not what I'm trying to get to. I'm not trying to. It's not whoever pays the least interest wins. It's who increases their net worth by the most wins. That is the objective here that we're trying to do with planning that we do for clients. And I'm doing wealth planning. Okay.
Yeah.
All the financial planners out there, they're selling products. I'm doing how do I increase your net worth, right? Top 20% of Canadians have $1.3 million. How do I increase your net worth, right? And so how much you're paying in interest is secondary to how I'm increasing your net worth. In fact, a lot of my very wealthy clients, and they're paying way more interest than people who are lower net worth, and they're going to forever, and they're totally happy doing that.
Well, here's the thing. When people, let's say the people who have a little bit of educational knowledge regarding finance, okay. They're told to look at what is the total cost of borrowing. What is that cost of borrowing going to be? Oh, that money is vaporized and wasted on giving it to the banks. So the banks get richer, and that money is essentially not available for you to invest. But I see on the other side where you're saying, okay, that's going to happen anyway, unless you're independently wealthy and can buy your house in cash.
Yes.
That's going to happen anyhow. So, what you need to do is use the portion that you've got and turn that into an asset. Is that what we're talking about here?
That's right. So let's look at a sample example of how a 50-year mortgage is likely to play out. Not for sure. There's some risks. There's risks just inherent in real estate, whether it's 15 years or 25 years or 30 years or 40 years or 50 years, you have inherent risks of real estate. Okay. This can somewhat exacerbate them, yes, but at the end of the day, the system is set up to move the money from the people who do the work to the people who know how to borrow smartly to invest. Okay,
all right.
And so what this would look like here, I've assembled two scenarios here. So I have a house. I have a $500,000 house. Okay, and that's kind of the average house in the U.S. about $500K. Okay. When in the U.S., the way you can put 5% down on your house, and you're going to pay basically a mortgage insurance of 1.75%. Okay. Yeah. So on day one, you actually going to owe $483,000, not the $500,000 unless your down payment. It's going to be that. And I would say even if you're going to rent, you're going to have some costs there too. So you're going to have, a damage deposit, maybe last month's rent. So you're going to have some costs there too. But let's just go on that for now. Okay. So we have $483,000. So we have this house, and they can actually put down as little as 3%, I believe, on a lot of them in the U.S. Wow. It's kind of crazy. But what you have is you actually have an asset that's appreciating in value. Okay. Now, we talk a lot in, we look at the historical average rates for the prime rate in Canada and what the mortgage rates are going to be. And people are usually a little too focused on what the rate is today and not focus enough on what the average rate was the last 25 or 30 years. They tend to mean revert. And so when people see that, mortgage interest rates are 7%, they freak out. And they think when mortgage interest rates are 2%, they think it's going to be like that forever. That's not, neither are that likely.
Wishful thinking.
Now in the US, they can fix in. The interest rates tend to be higher because they can fix in, and just the cost of capital, it's actually, it's been historically a little bit more in the US. And so, but we're looking at the average appreciation in the U.S. on a house. It's about 4%.
Okay.
A little bit different in Canada. We go through that in the bootcamp, but it's about 4%. That's the historical average appreciation. Okay. And they're going to pay around 6% on a mortgage. Okay. It'll be a little higher today. It wouldn't have been that high in 2021 if they locked in, but over time, that's what the last 30 years tells us, is most people are getting mortgages in or around 6%. Okay. That means it's again, when you own a house, it's not just going to be the mortgage payment. So on a $500,000 house, you're going to be paying just over $30,000 a year in just mortgage payments. Okay. That's on a 50-year term. Okay. Now, when you own a house, you don't just have mortgage payments.
Right.
Okay. So when you rent a house, it's you're going to pay the utilities either way. So I'm putting that aside because that cost doesn't really change. It's the same in either bucket. But when you own a house, you're going to have the property tax, you're going to have the insurance, you're going to have the repairs. Okay.
Yes.
That's going to be different. Okay. For the illustrative example in this, we're going to put 2% of the value of the house. Okay. Sometimes you buy a new house, it could be less earlier on and more later on, but 2% is a reasonable estimate for these models. Okay. So that means this person here who bought a $500,000 house doesn't have home ownership costs of just their annual mortgage payment. They have annual home ownership costs of the annual mortgage payment plus the property tax, the insurance, and the repairs of roughly 2%. Can be different in different jurisdictions, but $41,000. Again, I'm excluding utilities because you're paying utilities whether you're renting or buying, so it doesn't matter. Okay, now what happens in this scenario is in year one is this person actually has a net worth of $38,000. Okay, they actually have a net worth of $38,000. Okay, so now what's going to happen over time is this house is actually going to appreciate in value. The historical rate of return on real estate in the U.S. is 4%. So I'm paying interest at 6%, okay, and I have the asset appreciating at 4%. Now, you can look at that differential at the beginning, but remember, I'm paying 6% on the declining balance of the mortgage every year, right? I'm not paying 6% on the original balance of the mortgage every year, so my interest expense goes down, okay? So in year one, that net worth is going to be $38,000, okay? That net worth is going to be $38,000, and you're going to follow that down to as you pay off this house. This mortgage balance is, at 50 years. I would say half of the people are going to die with this mortgage. And so the fact of following it down is not that important. You're looking at this net worth number over time.
Gotcha.
Okay. You're looking at that net worth number over time. Okay. So once you get down to the bottom here, this person actually finishes with a net worth of $3.5 million. So let's just say they're a 25-year-old person and they pay off this mortgage until they're 75. It could happen. But at any time they can get off this train and they're left with the difference between the value of the house and the difference between the mortgage. Okay. And so at any time you can get off this train. So you look at someone who actually just rents, and here's the part is people think it's okay, it's cheaper to rent than to own. I hear this a lot.
Right.
Two things I hear is I'm going to paying this interest over the life of the mortgage. That's not important. That's secondary to the point of what's my net worth, what's happening to my net worth during that period of time. Okay, if I'm buying an asset that normally appreciates in value. Okay, It's the same thing with rent. It's like now your rent is appreciating roughly as quick. Okay, your rent is appreciating roughly as quick as the value of the house too. Okay, so your rents will go up over time. Okay, and this is important because it doesn't matter whether you it doesn't really matter whether you own a house or you rent a house. Your home ownership costs are actually going to go up in either way. Okay. Yeah. They're just going to go up slower if you own, because a portion of your home ownership costs are fixed on an original mortgage price. You have both the annual mortgage payments and the property tax and insurance. Okay. So when you rent, the entire thing is floating and increasing over time. Okay, so you just look at the increases in rents over time, and it's like eventually, whether you buy or own, it's like, remember you started out, even if you own the place, you started out $41,000 a year between annual mortgage payments and property tax.
Yep.
Okay, and then you finish just the property tax, insurance, and repairs. They're probably going to be $71,000 a year at that point. They're actually more than the total cost at the beginning, right? Yeah, that's crazy. This is the point where people don't realize. It's like, when you see seniors and they can't afford to pay their property tax, like this is the likely outcome. So in either scenario, this is a bit of a problem, okay? But they're just comparing one cash flow stream to another. But when you have a rent, it's like that entire thing is going up. Okay. So yes, in year one, I could put an extra $11,000 into the market. Okay. Every year I can take that and put it into the market. The average rate of return in the S&P 500 is 8%. Okay. But at some point, it's actually, in year 12, you're actually going to be paying more. This is where it shifts. Actually, year 13, you're going to be paying more in rent than you would in mortgage plus property tax, insurance, and repairs. Okay, so this, the renter is paying $48,000 per year, and the person who holds the property has $47,000 per year.
That is, that's crazy. So the person renting is actually paying more than the person owning the house at that time, year 12, year 13.
That's right. So like the two things where people the overemphasis on it is, number one, what's the rent over the life of the mortgage? Number two, renting is cheaper than owning. Yes, in year one. But eventually that is going to switch, right? Eventually that is going to switch. Yes, your property tax, your insurance, repairs are going to go up every year. But the portion that dealt with the actual property itself is fixed in time. And so people need to shift it. It's like, it's not paying off the house. It's like, in some way, it's like, it could be a 15-year mortgage or a 25-year mortgage or a 30-year mortgage or a 40-year mortgage or a 100-year mortgage or interest only. The point is you're fixing it in time, okay? And so it's somewhat, I'm paying more. If you think about it in another way, it's like in one scenario, I'm paying $30,000 in year one. In the other scenario, I'm paying $41,000 in year one. But in one scenario, I have rent control.
Right.
So if you look at it, it's like we don't really actually own these properties ever. We're always paying property tax to the government. In some ways, you're actually always renting it from the government, whether it's you're renting it from the landlord and the government or just the government, right? Yeah. But one is going to be more rent controlled than the other. Okay.
Yeah. The one thing I wanted to bring up, like this year, it is a spreadsheet, right? I mean, we don't live in a spreadsheet. So renters landlords would love for the rent to go up by numbers year by year.
Yes.
For their one renter that they've got. However, that usually isn't the case. But when people leave, that's when the rent can change. So this doesn't account for all of those scenarios. And at the same time, the renter is still paying for the property tax, is paying for the insurance, and paying for the upkeep through their rent. Is that
correct?
That's the case? Yeah.
Yes. They're just paying for it through their rent, right? So they have no portion of that cost that's been fixed in time by effectively shorting the currency through a debt instrument. It doesn't really matter if that debt instrument's 15 years, 25 years, 30 years, 40 years. Like, we had 40-year mortgages for a long time. You know what I mean? Like, there was, I don't know, a long time, but for a period of time in and around, call it 2005 to 2007, people were doing 40-year mortgages all the time in Canada, That was happening at scale, right? They have 40-year mortgages in the U.S. too. So the length of time, they can be interest only. Like, people aren't understanding that it's a debt instrument. You're effectively fixing the cost, a percentage of the cost of your housing cost. Not all of it. Some of it's going to float. The property tax, the insurance, and the repairs are going to float over time. That's going to happen. So a lot of people, they have to understand that their home, their living expenses will go up over time, whether they own or rent.
Right.
And that can be hard for people who, didn't plan for that later on in life.
And we're not even bringing into account inflation. We're not bringing into account legislation. I think a good point you brought up was that, essentially, you don't own any property that you own. It's all a rental from the government, whether it's municipal, federal, whatever. They can change the legislation on a whim, and that scenario changes overnight.
Yeah. I mean, your main risk in home ownership here, like the main risk in home ownership is the market risk. So you buy in an overheated market. Right. You buy at $500,000 and 2 years later it's $400,000.
Yeah. Give us an example.
This happens. I mean, and those of us from Alberta, like, we know it's like we still see people from Fort McMurray who bought in and around, call it 2005 to 2007, who are still underwater on the property that they bought. Okay, so the spreadsheet does not get you out of market risk, right? We're just looking at average rates of appreciation. Some places will be better than average, some places will be worse than average. Okay, and so we have to understand that is the big risk. At the boot camp, we teach people is like, these are the minimum amounts of due diligence you should do,
right?
Which should prevent a lot of those, buying into these overheated markets, because usually there's a list of due diligence you should do, and if the market's too overheated, you won't even have time to do them. So, but that's the market telling you that it's actually too overheated. You shouldn't be buying at that time. So, this is the point where people they're missing it. It's like, okay, I could take the difference and put that into an investment account, but you're going to actually see it's like, eventually my costs, my home ownership, or my living cost per year are actually going to be higher as a renter. And so at some point, I actually have to take money out of that investment account to cover the living expenses. If you're just assuming it's a closed loop and the renter just takes the extra in the extra that they have and invest it for the call it medium term. It's a long game. Okay, like this is a long game, and the shorter you play the game, the more market risk you have. So if you're hoping to get your exact 4% rate of appreciation and you're only in the deal for 5 years, that's pretty risky. Okay, if you're hoping to get your 4% and you're in the deal for 20 years, that's less risky.
Gotcha.
Still risky either way. Like,
yeah, for
there's
sure.
there's still risks in either scenario, right? But the point is that in this case, you'll see that it wouldn't matter 30 years, 40 years, 50 years, interest only. With the average rates of appreciation, because the currency goes down, like, you'll actually win by home ownership. Okay, that's the likely rate. And we need to see that Canada actually already has 50-year mortgages. They're just not these that are going to be designed for the conventional single-family homeowner. Okay, so I'm going to pull up this. This is right from CMHC, the Canada Mortgage Housing Corporation, and this is the MLI Select. Okay, so and this is basically a government-backed loan for people to build or buy purpose-built rental properties. Okay, purpose-built rental properties, and it works on a scoring of how long they're going to let you amortize the property. Okay, but you can see if you have the right scoring here, they are going to let you amortize the property over 50 years.
Wow.
50 years. These are 5% down over 50 years, right? In fact, like, these are 5% down. The mortgage insurance would be like 8% on these sometimes. So it's a big number. So like, you'll actually, put 5% down, have mortgage insurance of 8%, and you'll have a mortgage that's bigger than the value of the property, and they'll insure it too. They'll wind the whole thing in there.
Wow.
And these are, a lot of times these are sophisticated investors looking at it. We've helped a number of clients, whether they're selling to people in this program or purchasing under this program, right? And this isn't without risk. Like this has big risk, right? Like people see this and be like, okay, the currency's going down, I'll take this to infinity. It's like, but there's certain qualitative risks that would alter the spreadsheet. Okay, so in the home ownership scenario, just looking at the appreciation of the property, okay, under this scenario, it's like you should have appreciation of the property, but you also have rental income coming in. You don't have any rental income. A lot of people don't have any rental income coming in relating to their primary residence. Okay, so they're not just getting appreciation on the property. We start looking at not just what the gross rent is, but what's the cap rate? What's the net operating income of this property? Okay, and this is where you have to pay the property tax, you have to pay the insurance, you have to pay the maintenance. I would say most of the models drastically underestimate maintenance over the long term.
Maintenance and repairs. So don't forget these are renters, right? And renters always treat it properly, just like it was their own, right?
I mean, I see these applications and I see, and I see people's projections. Like, yeah, I can't argue with you that's possible, but I just don't think it's likely over time. I see the rate of repairs often being higher when I'm looking at the books and records, 5 years out, 10 years out, 20 years out. Like you just see these things tend to compound over time, right? But these are things where it's they're effectively, why these things work. It's like you're basically buying property in Canada. The historical rate of appreciation of property in Canada is actually 5%, not 4% like in the US. So that's, about the last 30 years, what we've been getting in Canada. And you're borrowing from the government at 4% for this. Okay, so that's just the appreciation. So the interest is somewhat irrelevant because it's basically just moving money from one account to the other. If everything works out, I'll talk about all the qualitative considerations that'll make it different. But basically, you have an asset that's appreciating at a faster rate than the interest being charged. So even if it was just interest only, it's fine there.
And also you're paying on the balance, right? Remaining balance.
Correct. Now, the other part is we're not just buying it for the appreciation. We expect net operating income from the tenants.
Sure,
okay?
Of course.
So we expect, to get gross rents of, 7% or more, and we expect to have net operating income of 4% or more. Okay? All of it with fake money. So we got 1% on that differential because we borrowed the government from at 4% for an asset that's going up at 5%, and we're also generating a cash flow stream of 7%. 3% of that is going towards other operating costs, and then we have 4% left over. And so, when you hear it, it's like 5%. It's like, yeah, but it was 5% on nothing, basically nothing down, right? It was 5% on someone else's money. It was 5% on the government of Canada's money, not on your money. Okay, so that's why it seems so attractive. Okay, and this is where sophisticated investors already know that these long-term mortgages have a big propensity to create net worth and actually create value and investor value. Okay, they already understand it. But let's talk about what can go wrong.
Okay.
Let's talk about what can go wrong. Okay, on the Canadian version. So on the Canadian versions, most of them are renewable on 5-year terms, and you can get 10-year terms on these, but most of them are 5-year terms. So you have interest rate risk on the renewal. So they're all fixed rate, these products, but you have interest rate risk on the renewal. Okay. And I'm going in order of what I think is ascending risks. Okay, do I view interest rate as I do, but long term, and when I think long, I mean 10 years or more. So on a 5-year basis, I could have some, on a medium term, I think I have, pretty moderate levels of interest rate risk. But on a long-term basis, the governments are broke and they can't afford for interest rates to be too high. And I show people this at the boot camp. It's there's a reason why interest rates didn't go to 20+% this time around, where everyone said it's just mathematically there's 3x the debt in the system. It wasn't going to work. Right?
Everything would collapse.
Yes.
Just blow up. Yeah.
But in the medium term, we have interest rate risk. Now, we can mitigate that by having enough cash reserves and liquid assets. Okay. We also have renewal risk. Okay, because this is a specialty product. Okay, if I have to get a conventional loan, if CMHC kicks me out of the program because you do something wrong and like you renew a tenant at a wrong rate, or I don't know, you post the wrong thing on Facebook or something like that. Like this is a real thing. This is a real thing. Okay, you have to go to the private market. Those rates will be higher, and they will expect more equity in the deal. Okay, so you have renewal risk. It should be fairly automatic, so they like the increasing order, but it's not zero. This is not a zero risk that you have there. Okay, you have vacancy risk. A lot of times I see these models, and the models, they really underestimate how long it takes to fill up the space with good tenants, and they probably underestimate the vacancy over time. And just because the market is where it is today in this local area doesn't mean it's going to be there in 5 years or 10 years.
I think you made an important point that we just glossed over there. You said finding good tenants.
Yes.
Finding a tenant is one thing. Somebody who can, fool you on an interview, come in and not pay rent.
That's right. And I got at least 5 units or more. I got to fill them right away. So it's like just because I have a vacancy doesn't mean there's a good tenant available. So that's a bunch of work, and so I have that. I still have the market risk. Imagine if I went in on this on Fort McMurray in 2007. That property that was $3 million is not worth $3 million. It's worth $2 million. The loan still $3 million.
Yep.
And so you're gonna exacerbate that level of market risk, and so that's real. Discerning buyers, maybe they can mitigate that. But now you start to see, it's like now I'm getting into more serious risks there. So I started with the interest rate risk, which I think long term, all signs point to the same or down. Okay. Right. Medium term, anything can happen, as we just saw. Okay. Renewal risk, it's like that can be there. Okay. But if I have enough cash reserves, I don't even really care. So if I have a $2 million property and I got $500,000 of liquid investments, it's like I can put the equity in the deal and I can get a renewal if I have to. Okay. So I'm not as concerned. Okay. The vacancy risk is like I can do that with cash reserves too. Okay. Now moving up the scope is I also have tax risks. And people forget that when it comes to real estate, you have 3 levels of taxation. You got the federal government, you got the provincial government, you got the municipal government, and they all have their hand out. And so that can be far less predictable because you're dealing with all 3 layers of government. And the spread between the lowest property taxes in Canada and the highest property taxes in Canada is pretty big.
Yeah.
Okay. And when was the last time you heard a municipal government saying, we're freezing taxes this year. We're not increasing anything. Right. So
let me think. I think the guy who just won in Calgary had made that promise. Is it going to happen? I don't know.
I'll believe it when I see it.
Yeah. Jeremy Farkas.
People's taxes rate, people's property taxes going down. Yeah. I'll believe that.
Not freezing, not going down, just not going up.
And remember that example. Like eventually, even if you own your house, the property taxes, the insurance, and the repairs will exceed the cost of the original mortgage. Like that is the trajectory for just the way our inflationary system works. So it's a big deal. Like those become a big deal. Yeah. Okay. And so you have tax risk, you have the 3 levels. Now you get into the real issues. It's like this all works on a spreadsheet, assuming I can increase the rents. But what if it gets more restrictive in terms of increasing the rents on tenants? And I think, it's very likely it's like, okay, we're going to renew your CMHC loan, but you have extra restrictions too. And so there could be broad-based restrictions, or there could be restrictions that are limited to those CMHC loans. It's like the debtor is a slave to the lender, right?
Yep.
We have to understand that, right? And especially if you don't have the liquidity to shift to a conventional mortgage, it's like you're kind of at the mercy there. And then I think the biggest one is kicking out deadbeat tenants.
Right.
That can get harder and harder and crazier in different jurisdictions. And again, all 3 layers of government can mess with that. And so these are the risks with these deals where they're not just like it's a surefire thing, because on the spreadsheet it always works. The spreadsheet would just say go buy 100 of these things, but the risks are pretty big in them. It's like, and so I view it as, they're a use case, right? Now, we had one not too long ago where one of the associates was showing me the deal, and the bank wanted them to cash in their liquid investments to do the deal. And I was like, hard no, like tell them, no way, we're going to do the deal, because our experience with these other deals is these things take a while to fill up.
Yeah.
They take a while to fill up. Maybe there's some overages in the operation costs when you get going. They take a while to fill up, and you need some liquidity to get it through. And I saw the liquidity that this guy was going to have at the beginning of the deal. I was like, no way. Like, and that's why it's like, people, they are, they come from like the Dave Ramsey school of thought, where they don't use any debt, and then they come from the other school of thought, is like, just because I can get approved from the debt, I should do it. I was like, no, this is way too risky. Eventually, interesting enough, the lender came back to them and say, okay, we'll do the deal without you putting that liquidity in. So it actually we kind of called their bluff, and it really worked in the guy's favor, because they actually came back and said, no, we're okay. We'll do the deal without you putting this liquidity in. And of course, at the same time, now we have the same qualitative risks, but at least they're somewhat mitigated.
Yeah, I mean, you're not using up all your liquidity to go into for a down payment on this thing, and then like, when are you going to get that back? Like, it's going to take years.
That's right.
To recoup that loss.
That's right.
That liquidity.
That's right. So, but like, ultimately you end up with these other risks that you can't, the tax risks, the rent increase restrictions, the ability to kick out deadbeat tenants that could get more and more difficult over time, could be different in different jurisdictions. So it's always like, when we're building like real wealth plans, it's like, although this looks amazing, the MLI Select mortgage looks amazing, it comes with a high degree of risk, and it's part of, what I believe is a more robust wealth building strategy. It's like, you generally want to have real estate, dividend paying stocks, gold, and Bitcoin. Like, that's how we do it, and how we utilize debt to acquire it is the magic. Like, that's the secret sauce, right? And not using any debt, where you basically need to earn it at a top 1% level to have any sort of quality of life, and not using too much debt where the risk of going to zero is very, very high.
Yeah. So in the scenario with this 50-year mortgage, for the average individual to do this, I think it's extremely risky, just for all the reasons that you mentioned. How about if you had a group of people, let's say 4 or 5 investors, who want to go into this, and they do it through a corp or some other way, just to spread out that risk? What are your thoughts on that?
It can be okay, but like, you tend to have like competing interests on how long people want to be in the deal, and so you just got to worry about the how aligned those people's interests are, and it ends up being, for an investor, a very illiquid investment, especially if you're the minority person. Like, real estate by nature is illiquid. That's what we teach people, but it becomes even more illiquid when you're in that sort of deal. Okay, and so I start to look at that as opposed to just going out and buying a REIT. I'm not sure I'm there. So like, unless these people are very closely aligned, I don't want to get into this sort of deal with someone I just met last year or something like that. So that tends not to be the deal. It just looks at you have to look at the amount of their income, the resiliency of their income, and how liquid they are, right? Because if they have liquid investments, then they can make all these mortgage payments on this property for 10 years. It's like, we don't have that risk, you know what I mean? But some of them, it's like, they can make the mortgage payments for 6 months, and they have one job that can't even come close to paying this mortgage. Never mind if they lose that job.
Right.
Like, that's what we look at, right? And it's not necessarily what the banks approve on. They kind of live and die by that spreadsheet, as if there's not going to be any extra repair costs or anything, or any extra vacancies. And so and so we look at it as like, how bulletproof is this strategy? What happens when 2008 hits in here? And like I like baseline that to everything when I do a plan. It's like, if I did this plan and 2008 hits here, what happens to this person? What happens to this person when they lose their job for a year or two? What happens in this wealth accumulation strategy, right? And I don't think enough people actually do. The banks don't do it. They just think, it's almost crazy. It's like, when you're acquiring residential mortgages, it's like, yeah, we'll use 39% of your income. It's like, well, okay, what happens if it goes to zero? And then they reject the person who wants to have 50% of their income, but they have the entire 5 years worth of payments in liquid cash. You know what I mean? Like in liquid investments that they could pay. There's no way they're going to miss it, right? It's just
it makes no sense.
Yeah, right? They just have these formulas that are somewhat arbitrary, designed for people's protection, but a lot of times there's a lot of scenarios where they can end up putting people in tremendous risk or preventing people from taking, making really prudent investments that really aren't that risky at all.
Yeah. The one ironic thing that I always, bring up is I can be working with a business owner who's been in business for 5 years or more, and they've got decent income and whatnot. And we're trying to show on their balance sheet that, they've made as little as possible, just so that, for tax purposes, right?
Yeah.
So the company's making money. On paper, doesn't look like they're making tons and tons of money. So trying to get them approved is a hassle. But any one of their employees that have been working for them for the 5 years,
easier time.
No problem. They got a solid, safe, secure job. It's been consistent. They're getting yearly raises and whatnot. But it's coming from the guy who's trying to get the loan right now. It's just crazy, right? It doesn't make any sense.
Yeah, it is pretty crazy. So just because they'll approve you does not mean it's not risky.
Right.
And just because they won't approve you doesn't mean it is risky.
Right.
Like that's the point where we try to help people see through the weeds. So I think, hopefully people understand, is like when you hear people and they go first on how much interest I'm going to pay over the life, it's like, that's not it. It's like, what would I do with the difference, right? Or if you hear, what's the rent, renting is cheaper than owning, for how long? At what point would that shift? Okay. And if you took that extra cash that you had and you invested it, once it does shift the other way, now you have to draw off that investment. What does that net worth look like, right? So it's not a yes or no discussion, and I think there's way too much on what's the duration of the mortgage, how much interest in the deal over time. It's like, how does this deal increase my net worth in 5 years, in 10 years, in 15 years, in 20 years? What if I do the other way? Not what that looks like 1 year out. What does that look like 2 years out, 3 years out, 5 years out? We have to know that.
Yeah, for sure. And the other thing that the spreadsheet is assuming is that renters will invest any extra funds that they've got towards an investment that's actually going to try and help them.
True.
Most live day to day, month to month, paycheck to paycheck. That's usually the scenario. So when it comes to that, this is assuming best possible case scenario in that 50-year mortgage on that $500,000 property. Mm-hmm. But really, people who are in a renting scenario right now, I think they should be thinking about, okay, how can I actually get started in investing?
Yeah.
Because I'm renting. I don't want to rent forever. I want to get into a house eventually. I want to buy a home.
Yeah.
What are the steps that I need to do to get out of being a renter into being a homeowner?
Yes.
Right?
Yeah. And the short term, like when we do our plans, like a lot can be different, because the ability to save tax-free for your first house, whether it's through your FHSA or RRSP, are pretty robust, right? But eventually that dissipates, and all of a sudden you're just left with your entire housing costs floating with inflation, as opposed to if you own a house, only a portion of your housing costs are floating with inflation. And so over time, your housing costs are going to go up in either scenario, whether you rent or you buy, but they will go up at a slower rate if you buy. And that's the important part. People are we need to learn debt, okay? Because, our parents bought houses with, Dave Ramsey bought a house with 5 years of median income. And we buy houses with 15 years of median income, and our kids are going to buy houses with 50 years of median income. Like this is a real thing. So you need to not bury your head in the sand and say all debt is bad or as much debt as possible is good. You need to learn to use debt responsibly.
Yeah.
How do I borrow at one rate and invest at another? And that is the game, and that's what we've been teaching. And so we just had the good boot camp that we just had. We had people from all over the country come out.
Yeah, it was awesome.
We're next one's in May. We're 1/3 sold already.
Awesome. That's
So
great.
we're 6 months out, and we're 1/3 of them are already sold. So, I think that helps. I see the comments there. Sean's in the comments there. Sean, it was good seeing you at the boot camp again. So a lot of people are complaining about how much money on the cost of the house after 50 years, house price plus the interest. Yeah. So again, it's the interest paid is secondary to how does this increase my net worth? What's the value of the asset, and how much is the value of the asset worth at the end of it, as opposed to if I would have used those initial savings to invest, what does my net worth look like there? The interest is secondary. Ultimately, what's the net worth in the two scenarios? That's what you have to run. Okay. And so what do you think about investing in multifamily properties? I see it everywhere on social media and claims that the process cash flow in a shorter term. Yeah, this is where I think it's maybe a lot of the influencers in the space.
Sure, yeah.
Maybe they haven't done it as long as I have, where it's like, if I just put it on a spreadsheet, I think a lot of the spreadsheets are overly optimistic. Like they think they're at a 5% cap rate, and I tell them it's like, it's probably 4 over time, because that maintenance expense is probably too low, and that vacancy expense is too low. Yeah. And B, there's qualitative considerations that the spreadsheet can't project.
Yeah.
And you're not so much in control of our own destiny. We don't really operate in a true free market. The government can change the rules of that investment at any given time. And so there's risks, right? Where you start looking at something like this, I get 50 years of free money. I'm buying a $3 million property with 5% down, put $150,000 down. Here we go, right? And it looks like I should just buy 100 of them, but it very quickly goes off the rails, and at a large scale with that much leverage. And so I don't think most people understand is like, how do you what liquidity you have to have, what income you have to have, and what liquidity you have to have to mitigate if that goes wrong, and is that catastrophic to your financial situation. Yeah. And
what's the last question he's got here? How do you decide how much debt to use for leverage, and how much is too much typically for either real estate or stocks?
I mean, I think like long term, in the short term, I'll, if a client looks like they have a large durable income stream with some liquidity, we'll lever it up. Like we'll go way up that realm. Like we go 90%, yeah, maybe, right? It depends. It's situational based, because it's like, what is the income that they have? That's 0% debt is actually just completely capital inefficient. And I think if you start to get into realms where your loan to value on real estate is less than 50%, you basically have no risk, and you're just inefficient at that point. And on stocks, if your loan to value is less than 25%, you have nothing, right? Now, most people have way higher real estate and no debt on their on their investments to start, and we have to show them it's like, hey, you were always borrowing to invest. No one just taught you how to do it properly.
Right.
You had an RSP over here and a mortgage over here, and they lied to you telling you you're not borrowing to invest, but you are, because you could have not contributed to that RSP and put it on the mortgage. So once you start to understand how to actually do it properly, but we have to understand that the differences in how those things are financed. But those are some long term, like when you're 65 years old, it's like that. Those are some of the ratios where I'm looking for. It's just like it's bulletproof for 100 years. Like that's where I'm trying to get to. But sometimes I'm willing to take more risk earlier, because I got to get to where I'm going first, right?
Gotcha.
The main risk is like, I'm not going to get there. So yeah, and I think that's what we have. So hopefully that's helpful for someone when you're hearing these like large claims about length of mortgages. It's like that, all of those, and amount of interest paid. It's like renting is cheaper than owning. It's like, that's, for how long, right? What does that net worth look like 10 years out, 15 years out, 20 years out? What does that rent look like 10 years out, 15 years out? What's that housing cost eventually 10 years out, 20 years out if I don't get on it? What's the market risk in this area that I'm at? Like, look at it more holistically, and I think people are on a better path then to actually building net worth.
All right, awesome. Thanks, Josh, and we'll see you guys on the next podcast.